and a very warm welcome to our, I think, 13th or 14th iteration of our knowledge series. Uh, for people who have joined us for the first time, we at Merisis Wealth strongly attribute that information and knowledge sharing is very critical, and we try to bring up topics every alternate Thursday this time that may be relevant to the ecosystem and the clientele that we either service or get interacted with. In this line, same spirit, IPO readiness came as an important initiative, and we have today an exciting webinar on IPO readiness, a guide, and we have some very marquee speaker in Devesh. He's already had a couple of successful IPOs at different sizes, so fairly well experienced from that perspective. Also now helps some of the companies to look at that side. So for the people who joined us for the first time, just a quick, brief about us. Merisis, our genesis is as an investment banking firm uh, that started about 15 years back. Uh, Arun, if you can have the next slide. Yeah. So we started about 15 years back as an investment banking firm. Uh, since then, we've had quite an eventful and marquee journey. We've had transactions with more than $1 billion, and about half of them have been M&As and strategics. We work very closely with tech-focused initiatives from fintech, edtech, consumer, enterprise technology, transport, uh, and since then we have uh, worked alongside various founders across various stages, primarily growth phase, and it has been quite a rewarding journey so far as being part of India's growth story and this ecosystem. We also, through our wealth management, have our own Cat 1 Angel Fund and also our own PMS offering that we work very closely with. Uh, as I said, our is not for around enterprise, entrepreneurs, and corporate professionals, and we work for the entire gamut covering institutional requirements from treasury management to individual and personal wealth management with a very high focus on private side of the market since we understand that better. We are supported well by a very marquee team. Uh, uh, as you can see, Akshay heads our PMS as a fund manager. Fazal has been one of the founders for Merisis. I look at wealth and some part of other initiatives. And Arun, a seasoned professional, looks at the business side of the wealth piece. In all, a market team that has almost 75, 80 years of experience amongst them and very focused in this in this area. Coming to today's webinar, we have Naresh representing Merisis Wealth. He heads our product and investment advisory. Uh, Strong background, a very marquee and a seasoned professional, almost just under 2 decades of experience, CFNCI by qualification, and has been in this industry forever. Has worked in companies like Standard Chartered, HDFC, and has spearheaded similar roles in his earlier capacity. He will be the moderator for our session today. We expect it to be a very engaging session, a very exciting session. And during the session, whenever you feel free, please keep putting your questions in the Q&A box, and we'll take it up at appropriate times. We'll also try this to be engaging and ask you some questions as we go along. So over to you, Naresh, and a very warm welcome to everyone again. I think it'll be appropriate for you to introduce Devesh before we move ahead on this side. Uh, Over to you, Naresh.
Yeah. Thank you for the introduction, Ruchi. Good evening, all, and thank you all for logging into today's webinar. It's my pleasure to introduce Mr. Devesh Desai. Next slide. Who has almost 34 years of experience, having worked across various professionally managed companies, promoter-held companies, MNCs, and served in various capacities across roles in finance, IT, financial planning analysis, controller, and CFO roles as well. Devesh has successfully led companies through pivotal growth journeys and milestones, including IPOs, private equity funding, mergers and acquisitions, joint ventures, systems transformation, modernization, and investor readiness. He has a track record of two successful IPOs, one of which I think everyone has heard about, Deccan Aviation Limited, or more popularly known by their brand Air Deccan in 2006. Also in 2017, he was behind the successful IPO for SIS Limited. Currently, he's engaged in one more IPO from a subsidiary of SIS called SIS Cash Management Services, and expected to have it this year in 2026. So, welcome, Devesh. Happy to have you here.
Thank you, Naresh, Ruchir, and also to Merisis Group for hosting me and giving me this opportunity to share my thoughts and experience with IPOs and IPO readiness in the Indian context, especially.
Thank you. So, before we move into the core topic of this webinar, just thought we'll give a flavor of the year which just went by, and how it was as far as Indian IPO market was concerned. So 2025 record-breaking year for the Indian IPOs. There were almost 373 IPOs, including 103 main board and 270 SME IPOs, which came in last year. They've raised almost 2 lakh crores, or to be precise, 1.95 trillion rupees has been raised through these IPOs. There have been certain very marquee IPOs, for example, your Tata Capital, HDB Financial Services, which also came in last year. If you see in terms of which kind of businesses have got listed, they come on entire spectrum. NBFCs have been the leader here in terms of fundraising, but they have been closely followed by other sectors as well. For example, capital goods, technology, and healthcare. In terms of profile of those companies, we've got a healthy mix of both, old economy companies as well as new economy companies at the same time. It's quite heartening to note almost two-thirds of these IPOs listed at a premium, or rather, and there's a premium to their listing price. So again, making money for the investors at the same time. Okay, so I think without further ado, let's get into the core part of our webinar, Devesh.
Yes.
I'll start off with a very fundamental question, actually, which is why should a company look at getting listed? And more importantly, when is the right time for the company to get listed? Perhaps as a follow-on, given that we spoke about both main board and SME IPOs, and there are the two segments, clearly defined segments over there, which segment should one company consider? And finally, I think India is not the only place where one can get listed. There are also overseas listing possibilities available for a few companies. So, Devesh, would love to hear your thoughts around these.
Thanks. So before I get into the IPO question, let's look at what are the other ways of fundraising, because one of the primary objectives of an IPO is to raise funds, either for the shareholders or for the company. So you start with whenever you start your business, you start with your own funds, commonly called as bootstrapping. Then at some point you take on debt when you think you require some more money. When you think you're matured a bit, then you go into private equity. You can get into private equity early stages, late stages, middle stages. I think we all know this. You can do an M&A. You can sell your business also if you want, and then get some money and start a new business. That's also something which happens from time to time. And of course, the ultimate is get listed and go into public markets, do a public offering, either sell your share. IPO is the only route which gives you liquidity, valuation, and a platform for future fundraising, as and when you would like to do it. And you can also use the shares as some kind of a currency if you want to do M&A transactions. Now, the question is, why would a company want to get listed, and why get listed, basically? So, of course, as I said, mentioned also that you might want to fund your growth, and you think that you had enough of debt, and then let me look at uh, public market.
Devesh, I'm sorry to interrupt. There is some messages on the chat saying, can you be a bit louder?
Okay.
So, yeah,
Okay. Is this better now?
yes, please.
Okay. Sorry. Of course, one of the reasons for getting listed is to fund your growth. You would have had taken enough debt. You would have had your share of private equity, where you would have diluted a bit of your control. And now you think, okay, my business is a bit mature, and I think I can get a fair valuation from the public markets. Timing is also right. I might want to give an exit to my existing investors because private equity generally has a short time span of 3 to 5 years in any company, and the fund would need to realize some value from the investments and return money to their investors. Simple thing, you might want to discover your value because all these old age companies, companies which are there for many years and who not even may not have had private equity, may not have even used debt, but now they want to fund the next avenue of growth, or the family wants to get into newer businesses. You might use this opportunity to get some value out of your existing business and fund other businesses. You might want to retire high cost debt because sometimes you would take debt when you're not getting equity. M&A, for example, till recently, banks were not allowed to fund M&As in India. So if you had to take debt, I would either have to take some NBFC debt or a bank subsidiary debt, but not a bank debt, and that would not come cheap. So you take it as some kind of a bridge capital, and then you use an IPO to retire it and bring down the cost of your funds. But the most important thing is you should consider what the life stage of your company is, life stage of your business is. That should be the most important consideration for listing or getting to public markets. You get in too early, then you are possibly undervaluing yourself. You get in too late, then there's possibly not too much of runway left to continue growing the business. You have to find and strike the right balance. It's the founders and the promoters who know exactly in their mind when is the right time. No one else can do it for them. Bankers can help you, advisors can help you, but only you can take the decision and take it for the right reasons. Don't take it only to get some money and that's it, but take it for the right reasons. If you can expand your shareholder base, get investors on board, and show them a growth runway and show them value addition and actually deliver it, and you know that's the right time, that's when you should get into it. And yes, to address your other two questions of SME and main board, SME is a small capital base where you have between 10 to 25 crores of normally 10 crores of cap to 10 crores of capital, share capital. It could go up to 25 crores. Then you go into the SME board. In the main board, of course, it's much larger capital base and much larger companies. So you can figure out from there what to do. India overseas, good question. If your business is primarily in India, your revenue and profits are primarily from India, list in India. If it is not primarily in India or the majority of your revenue and profits are not from India, then consider carefully where you are based, where your headquarters are, and where you want to list. Because in India, the investors in India are paying for India premium. They don't understand other markets. You'll find very difficult to get a proper value for your company.
Thanks for your thoughts, Devesh. So, while you very well elaborated, why and when should a company consider getting listed, maybe we should also touch upon, two very common concerns the founders and promoters have on why they would not like to get listed, and I would love to hear your thoughts on that. The first is, founders, promoters believe that, those companies which they're very painstakingly, grown, suddenly they lose control once the company gets listed. The control which they were earlier enjoying, that is not something which they can take for granted going forward. The other concern is that, because of quarterly publishing of your financials, which is pertinent for all public companies, that, their secret source or their financials, etc., are now open to competitor scrutiny. That's the other fear which normally founders have, which will prevent them from considering the listing route. So just wanted to hear your thoughts on both these concerns.
I think the third concern that they will have to disclose the strategy or the business model, so to say. That's one of the things. So let's address the easiest one first. My financials will be under scrutiny. Well, they're already under scrutiny. You go to MCA, pay one piddly fee, and you can get any company's financials. So, of course, you won't get quarterly financials there. You'll get the annual financials once they're filed and registered on the MCA website. So I think that we can keep aside for some time. Let's take the first one, which is control. Now, what do you mean by control? Does control mean I would like to do anything I want? Or does control mean I should be able to control the strategy, control the delivery of the strategy, and control the delivery of the results out of the implementation of the strategy? If it's the first thing, public market is not for you, because yes, you cannot, literally you cannot do what you want. You'll be subject to board approval, shareholders approval, investor scrutiny, analyst scrutiny, proxy firm scrutiny. Everyone is going to scrutinize you. But if it's the second one and you're confident that you would like to continue driving the strategy, implementing the strategy and the financial results, and yes, there will be minimum amount of scrutiny, which is natural. If you're going to get public money, then public is going to ask questions, and public, through the analysts and investors and proxy firms, are those who ask the questions. Then public market is for you.
Makes sense.
But
Makes sense.
the other thing also, you need to have credibility. You need to have some minimum governance. I'll touch upon this a bit later, but if you have that, please go ahead.
Okay, great. So, one thing which we do in all our webinars is, we encourage audience participation. And one of the routes of doing that is, by having audience polls. So I think this is the opportune time to have our first poll. Shreya, I'll request you to just publish our first poll, please.
Thanks, Naresh. Hi, everyone. So I'll be launching the first poll for today. Can loss-making companies be listed? And the options are no, yes, but subject to certain criteria. Yes, but only if they're making profit at EBITDA level. So I'd engage the audience. Yeah, so the audience is engaging. People are voting for the second option.
We're getting a good number of votes even for the last option.
Right. So 66% of the audience voted for the second option.
Almost 1/4 have voted for the last option, and nearly 10% have voted for the first option. So thanks for sharing this, sharing the poll results there. Okay. So the reason why we had this poll actually is that, one of the objectives of our webinar is to address, rather counter certain myths which one may have on the entire IPO readiness process over here. So this poll actually leads me to the first myth which I want Devesh to bust. And the myth is that, only profit-making companies can be listed. And there is no room for loss-making companies or those companies who are not making any profits at the moment to consider listing. How much truth is there in this statement, Devesh?
That's not true. Everyone knows of even the recent tech companies who have never made money and who are not likely to make money. And the law allows. There are certain criteria, of course. Can you remove the poll thing, Shreya? That's coming in the way of the screen, I think. But anyway, let me just, so basically the criteria for main board is assessment of certain financial criteria over a 3-year period. If you meet these criteria over a 3-year period, you can do an IPO under a particular regulation. If you don't meet these criteria, you can still go ahead. But the difference is that if you don't meet these criteria, you need to offer minimum 75% of your offer to what is called qualified institutional buyers. Things like mutual fund, FIIs, and these kind of so-called sophisticated investors. You need to offer minimum 75% of your offer to such categories of investors. If you meet the criteria, which you can see on the slide, then you need to offer around 50% to them, and the balance 50% between HNIs and retail. That's the difference between meeting this criteria and not meeting the criteria. SME has got a slightly different criteria of post-issue paid-up capital profits and how much OFS you can do. But no, it's not true that only profit-making companies can go ahead with an IPO.
Yeah.
And, and if you come to the offer size, how much do I need to offload in an IPO? So how much I need to offload in an IPO is for companies who have got up to 4,000 crores market cap post the issue, you need to offload 25%. You need to offer at least 25% to the market. For those between above 4,000 crores, you can do even 10%, subject to a minimum 400 crore offer size, and then slowly take it up to 25% over a period of time. Now, there's a proposal before the government by SEBI to dilute some of the initial dilution requirements for large companies, large cap companies, but the government is yet to notify the new proposal. It's expected shortly, and once that is there, then you might find a few more large companies coming out with public offerings. Naresh, just this, I think we can take off this poll and move the slide. I don't think the slide is moving.
The slide is moved. Can you see the slide that says minimum offer size
Yeah,
existing?
I can see that, but I can still see the poll also. Should I?
Devesh, you can just close the poll at your end or just put it on
Done.
the corner.
Okay, sorry.
Yeah, yeah.
Okay. So this is the existing rules for minimum offer size. You can see up to 100,000 crores, you need to offload 10%. And above 100,000 crores is 5,000 crores plus 5%. And you have to reach 25% of public shareholding in 3 to 5 years. But if you're less than 4,000 crores market cap, then you need to hit 25% right at IPO time.
Correct. Also, in terms of what is being proposed, if you could just share some thoughts around that.
Yeah, you can. I think audience can see what is proposed. Up to 50,000 crores, the concept remains the same. It's 400 crores, 10%, 25%. It remains the same. It's changing for market cap over 50,000 crores. There are two new thresholds: 50,000 crores, 100,000 crores, and over 500,000 crores. You've got these three thresholds. Government is expected to notify these new thresholds shortly. They have been proposed by SEBI a few months back. Once that is done, as I said, you'll find, hopefully, you find a few more large companies coming out with public offerings.
Very insightful, Devesh. So the second myth which I wanted you to bust was, that listing itself is a very cumbersome and expensive affair, and it is something which is best avoided by, let's say private companies below a certain threshold, either in terms of revenue or profits, etc. So is there indeed such a threshold which one should consider before going public? Uh, you know, and how much truth was there to say that it's cumbersome and time consuming and expensive? Just your views around this.
Cumbersome, if you use the word cumbersome, would depend on how ready you are mentally and physically for this. We'll touch about this a bit later, but you need to be mentally prepared for public scrutiny. You need to be mentally prepared to change the way you work, change the way you disclose, to change the way you share your information about your company, and how much are you willing to disclose to investors. Cumbersome, yes, would also mean if you're not prepared, then it'll take a longer time to get ready for the process, go through the process, and then live your life after listing. It's something like a quality certification. It's comparatively easy to get the certification, but then to constantly maintain that certification and get that audit and clearance done for that certification year after year, day after day, month after month, that's the difficult part. For IPOs, yeah, relatively, if you get ready, you get your books ready, get everything ready, you can go through the process. But then are you ready for that grind, your quarterly grind, your treadmill at the end of the day? Are you ready for that? Do you actually need to do an IPO? As I said, you need to consider why you're doing it. It's very important why you're doing it. IPO will cost money, and of course, you can recover that cost from what you offer in the IPO. It's part of the the uses of the IPO in one sense. It could cost you anywhere between 5 to 10%, depending on the size. So a larger size would have a smaller percentage, a smaller size would have a higher percentage. And one thing to note is that if you are a selling shareholder, you need to pick up your share of the expenses. The company will not. That's the law.
Okay. I agree with you, Devesh. So essentially, what you're saying is that the it is cumbersome provided you are not ready for it, you're not well prepared, structured, and systematic in your entire approach towards IPO readiness. Definitely, that's how it seems. Also, at the same time, it may be an expensive affair, but given that what you have introduced over here, it seems to be worth the effort. Given everything goes in the right order.
Absolutely.
So, Devesh, one more thing I wanted your thoughts was around that, listing, in fact, means that a company is now subject to multiple regulators and multiple regulations. Some of these were not applicable when they were in their private avatar, you know. So just wanted, you to introduce some of these regulations and regulators to our audience. Maybe not really going too much into that, but just kind of a flavor if our audience could understand who are the various regulatory bodies who also have oversight over these IPOs, the entire IPO process, etc. And what are the regulations which they need to be mindful of?
Yes. So till you actually go for listing, till you go for IPO, you are governed fundamentally by the Companies Act. So the Companies Act defines what you can do, what you can't do, when you have to do what approvals you have to take, what timelines you have to adhere to for various things. But once you get into the IPO process, getting into the IPO process is once you have appointed your bankers and counsel and you decide I'm going for the IPO. Then you start getting subject to some regulations from SEBI. Now, what are those regulations from SEBI? So the first thing is what is called ICDR. All bankers and lawyers talk this word ICDR. ICDR is the compliance and disclosure regulations related to public issues. Those govern what you need to disclose, what are your restrictions, like what you can use the money for, who you can offer the shares to, all the disclosures you need to make in your prospectus, and all the timelines you need to adhere to before you actually get listed. All these compliances. That is what ICDR means. Then you have what is called LODR. Earlier, you used to have a stock exchange agreement, which was everyone knew that clause 40. So that was one famous term across the system, clause 40. That has been fundamentally substituted by the LODR. LODR is listing obligations and disclosure regulations. Once you are listed, what are your ongoing obligations in regard to governance? What are your ongoing obligations for reporting, your compliances, when you have to report what? Now, for example, you not only have to report your quarterly results, but let's take a basic example. If you intend to declare dividend, you need to announce to the market in advance that I am going to hold a board meeting after so many days to consider declaration of dividend. So these things are not meant to come as a surprise to markets. You want to do a buyback of shares, again, the same process. You want to consider, if you're considering an acquisition, then of course, the moment the board approves the agreement to make the acquisition, you have to announce it to the market within a certain time frame. A lot of things have to be announced to the market within a certain time frame so that the market has full information. The market gets the first information. So the regulator for a listed company is the first line of regulator is the stock exchange. The stock exchange is implementing and enforcing the SEBI regulations in one sense. Of course, you have different SEBI regulations regarding to ESOPs, how and when you can give stock options, sweat equity, and share appreciation rights and different kinds of instruments. If you want to do an M&A between a listed and unlisted company or two listed companies, or you want to do a spin-off or a demerger, etc., you have a master circular from SEBI which governs that. That's one route of getting listed. And then, of course, your Companies Act continues, Income Tax Act continues for the shares that you sell in the offer. And how much you can offer to the market, how much you need to offer to the market, and the fundamental regulation for shares is the Securities Contract Regulation Act. And that is what I was suggesting is yet to be amended to give effect to the proposals of SEBI to fix the minimum offer size for companies. Fundamentally, these are the regulations you are subject to, and it's sometimes it might seem cumbersome. It's a lot of work to get on top of it, but once you're on top of it, pretty much it runs on its own steam. And of course, with the IPO comes certain lock-ins and restrictions. Promoters have to make sure, and even it's made sure through the depositories and the demat. Next slide. That the promoters holding 20% of post-issue capital is locked in for 18 months, and the remaining holding of promoters is locked in for 6 months. All other pre-IPO shareholders are locked in for 6 months. If you have got shares out of exercise of ESOPs, no lock-in. So you are treated special. Employees who have got stock options are treated special. They can also offload their shares as part of the IPO. All shareholders, typically private equity and similar kind of shareholders who enjoy special rights, veto rights, affirmative consents, and different kinds of rights pre-IPO, all has to fall away. Of course, you can bring them back in a certain form after taking approval of shareholders, but at IPO, all has to fall away. The only right which can remain is the right to appoint directors, which has to be approved by shareholders after IPO. That's fundamentally the whole regulation and basic structure in its simplest way as to what governs when you're doing an IPO.
Thanks, Devesh. I think it was very insightful. I'll now pose the same question to my colleague Arun, given that he's headed a public listed company in his previous role. So, Arun, if you could just share some experience with the regulators and the regulations, having headed a public listed company.
So, Naresh, I think Mr. Desai made very good points. I would just like to add saying that other than the regulators,
Arun, your voice is a bit dim.
Can you hear me better now?
Slightly.
Is it better? Hello, is it better now, Mr. Desai? So what I was saying is that other than the regulations that Mr. Desai listed, once a company gets listed, then we have also independent directors on board. And the fundamental point of having independent directors is to protect minority shareholders. And therefore, it is their sort of duty as per Companies Act to ensure that all the information that is provided by the company to stock exchanges is fair, transparent, that the companies are governed in a very fair and transparent way. And that's what happens in board meetings. So I think I would say role of independent directors become very critical. Once you go public, once you have a full board, right, and therefore most of the independent directors therefore more focus on how you are actually reporting, more than the numbers that you are reporting. How is it getting reporting? Is it fair valuation? Also, are third-party transactions, related party transactions getting reported properly or not working properly? So I think that those as well become a part of the chapter first.
Thanks, Arun, for your views here. So, Devesh, let's dive into a very important part of our discussion today, which is basically the entire IPO process. If I were to visualize maybe all the key steps of the entire IPO readiness process, what elements would this encompass in your view?
So first, I think decision, you have to make a decision first. Do I want to go public or do I want to explore going public? And of course, the people who take you public are the registered merchant bankers and counsel. So first you need to get your bankers in and try to understand from them the market, your intended valuation. You give them a business model, and they come and give you your thoughts on the valuation, on the pitch, on the timing and the markets, and different kinds of things. And based on what you want to achieve and the size of your issue, you decide to choose 1, 2, 3, 4, 5 bankers who will take you into the process. Once you've chosen the bankers, once you made a decision and once you made a selection as to who is going to take you to market, and then starts the real work. And then you get into your diligence. Lawyers come in, bankers come in, they do diligence, financial diligence, legal diligence, compliance, commercial, and understand your business, and they start drafting the document. While they are drafting the document, the finance team and different teams within the company, the legal team, sector team, finance teams they are running 2, 3 projects at the same time. They're running the business and they're running this project at the same time. It's stretching of bandwidth, of course, and but It's a long run process. It's an intensive process. If you have one entity within the system, it's easier. If you have multiple entities within the system, you have a group structure, it makes it more difficult. The same process is done for material subsidiaries. And if there's a foreign subsidiary which they don't understand the environment, they'll go and do diligence over there or through someone in that market. And it takes 3 to 6 months, sometimes even 9 months to prepare the DRHP based on your readiness. Readiness of data, readiness, the cleanliness of your data, your housekeeping, data readiness, and your compliance, whether you have any gaps in your compliance, whether you have any gaps in your data, whether you have any gaps in your control. All of these are assessed, and depending on your readiness, it takes 3 to 6 to 9 months to get your DRHP, as they call it, draft red herring prospectus, ready. Once that is done, it is submitted to stock exchanges and SEBI for approval or comments, as they call it. And at the same time, it is available for the public to also give their comments to the stock exchange and SEBI. This process does not take anything less than 3 months. No matter what is written in the regulation or no matter what is there, it takes 3 months. And just be prepared for that. And in that document, your financial numbers and statements cannot be more than 6 months old. So if you want to file your document, say in March, then make sure that you are not having statements older than September or December. December is better because then by the time SEBI approves it, then you only have to add another quarter and you can go to the rest of the process. But while the regulatory review is going on, you can do limited engagement with the market. You will start preparing your deck, you start preparing a pitch deck, the bankers start doing that and getting ready for what's called roadshows. Once you get your SEBI approval, or they call final comments or observations, SEBI does not really give an approval. It just says final observation. So that final observation means, okay, all the disclosures you have made are correct. Whatever else I wanted to do is what you have agreed to do in the next round of the document when you will submit to me. And okay, now I've got no further comments. So these are my final observations. And then you engage investors and get your valuation feedback, get valuation, discuss on valuation done by the bankers, and what is called price discovery at that point of time. If you think it's all working out, if you think that valuation is fair and you think you've got enough investors on board, then you update your DRHP if your numbers are more than 6 months old, file it with the regulator, get a quick approval in 7 to 10 days, and fix your price band, file your RHP, open the issue. So if after regulatory review, your process is fairly quick, if your road shows go to expectations, then you can be listed in a month and a half after that. But if there's back and forth going on valuations or different other things, or maybe economy is tanking or something is happening, then of course it takes some time. But yeah, overall, if things fall in place, 6 to 12 months is a reasonable time to expect to get listed from the time you make your decision on bankers and counsel.
Yeah, thanks again, Devesh. And I think you've really well clarified the steps which are involved all the way from decision-making criteria, moving up, to your final observations from SEBI. Not really an approval, but that's how the approval is termed by the regulator over here. And finally, moving on to the listing space. I think so. Maybe in terms of an activity chart, this is how the activity chart would look.
Yes. This is very high level. Of course, it's a full project and it will involve many number of steps, many number of people involved, auditors, counsel, secretarial team, finance team, to some extent operational team, and your CEOs and everyone gets involved for the road shows. And yeah, there's a lot of work, but this is high level is what you need to, what you will experience during the process.
Very useful for sure. So, Devesh, it is said that, the life of a promoter fully changes once, post listing. Can you add some flavor to this statement?
I think it's not only the promoter; it's a lot of life-changing scenario for the CFO and the secretarial team also. And during the IPO process and after is the CFO, who's like literally in a lot of ways the front face of the process. He's in the thick of it, and it's, I think, more the CFO's life changes. He has to manage the reporting, he has to manage the compliance, manage the investor relations to a large extent. He's on the front foot over there. And for the governance framework, the governance, I will say it's two parts of governance. One is the external governance, which people see. One is the internal governance, which the outside world does not see. Now, the internal governance is sort of one sense easy. You need to get your financial systems in place, internal controls, process controls, risk management, and approval authority matrices, and different kinds of controls over reporting and disclosures, etc. Those are things squarely, more or less squarely in the domain of the CFO, and he has to make sure it's put in early rather than late. So that gives your basic fundamental faith or assurance that certain things are going to happen in the correct way. Then comes the external governance. What do people see? Now, when I say external governance and what people see, mean what are investors seeing, what are analysts seeing, what's the public seeing, what the regulators are seeing, and what the shareholders are seeing. I think Arun alluded correctly that one of the important elements of the whole process is independent directors. And their job is to protect the interests of minority shareholders. Minority shareholders means non-promoter shareholders. Now, how does one assess whether that external governance is effective? External governance largely led by independent directors. So there are 3-4 ways by which it is seen. So one is during corporate restructuring, mergers, amalgamations, demergers. One is during related party transactions, which come to shareholders' approval. Third is managerial remuneration. And fourth is conflict of interest. These are the 4 ways by which the outside world sees whether the governance is working or not. And going back to one of the earlier questions about promoters think I will lose control. So as I said, if the promoter thinks or wants that they should continue to do what they were doing without anyone asking them, and they should be able to do whatever they want to do, then yeah, there's a different scenario you're going to see. And you can see different examples of it. Conflict of interest, ICICI Bank, Yes Bank case. Pull down the promoter, almost pulled down the bank in one case. You talk of managerial remuneration, I don't know how many people remember Eicher Motors, the makers of Royal Enfield. That remuneration of the MD, which should not have actually been called into question, was rejected by shareholders, and they had to come back with a revised package. We know Religare what happened with the ESOPs and other things to the CEO. Related party transactions, we are seeing recently what's happening with JSW, where some promoter companies are sought to be purchased by the main company, and proxy advisors are contesting it on the grounds that these businesses could well have been incubated within the main JSW company. So these are the red flags of governance which the external world sees, and the impact is felt in no other way but in the share price. So if you're prepared for this, and if you're prepared to have this process scrutinized, then yes, public market is for you. But if you do not want it, and you do not think you want it, and you do not think it's necessary, then yeah, I think you should carefully consider whether you actually want to get into public markets.
I think rightly said, Devesh. It's almost like considered like a regime change or a change of an era, end of one era and beginning of a new and exciting era. The way we see it moving from a private limited company to a public limited one. Arun, if you could also share some experience of yours, in this line, how life changes.
Yeah, you know, I would say almost 10 to 15% of the time of a MD or a CEO. While you have the CFO, you will have your company secretary and I think
Yeah.
I think I'm audible now.
Yes, much better now.
Yeah, sorry for that. So basically, I think a CEO or an MD will also have to spend 10 to 15% of the time because the board meetings have a rigor, the reportings have a rigor. There will be quarterly board meetings. Like Mr. Desai said, there are many committees of board which will also happen, and these committees will also have meetings, and some of these committees will have, let's say, an action taken report, and therefore even that needs to be sort of put in certain formats. So the secretarial team will be busy, all of which that goes to the board has to go through the CEO's desk. He will be busy, especially during the time when you have board meetings. Around that time, of course, the focus is completely on, the board meetings, audit committee meetings, remuneration committee meetings, and all of that. So yes, it does change. Life does change. And also, there's one more point, and Mr. Desai, please, do correct me, that there is also certain event reportings that happen, right? So any event which may or may not have a material impact. So how do you report that? So even those things, become important from a perspective, and you will then, spend time in understanding how to do this, how whether to report, not report. For a company which say 100 crore of revenue or say 1,000 crore revenue, any event in their life, which could be setting up a subsidiary or opening a branch, for example, which is say adding about 50, 60 crores of revenue, is a reportable event. That has to be seen from that lens. Over to you, Mr. Desai.
Yes, it depends on some items are left to discretion, what is material, what is not material, but largely there's a definition of what always has to be reported, irrespective of whether it is material or not. And yeah, if you win a large contract which is a significant addition to your revenue, yes, you expect it to report it to the stock exchange. Similarly, if you lose a contract which has a significant impact on the revenue and the profit, yes, you expect it to report it to the stock exchange so that the wider audience, wider shareholder community knows of it and can accordingly price it into whatever buying or selling decisions they are doing. So the whole concept is democracy. Uh, Material information cannot be kept to you. You have to share it immediately or within a certain time as soon as you come to know of it. And of course, all this are listed in the LODR. It's a huge document, the LODR, and the sectoral team and the finance team really has to be on top of it.
Thank you, Arun. Thank you, Devesh. I think very good insights over here. So, I wanted to ask, what would be the common pitfalls, which maybe founders should avoid, while in the entire IPO preparation journey, given that, you're new to the entire process. It's like literally a regime change or an era change for so many of them, And also, we have seen in the past quite a few incidents, high-profile incidents also of certain IPOs being tripped, because of certain, I would say certain missteps taken by the founders, etc., which kind of trip the entire process. So, what could you identify some of the common pitfalls which one should be mindful of?
Yes, so I think the first thing which is a common pitfall is compliance and disclosure issues. And for a long time, there were a lot of companies who had issued shares to more than 50 shareholders at a time. Now the threshold is, of course, 200 shareholders. And if that was the case, then it was deemed to be a public issue, and a lot of companies did not have the compliance in place for that. And so when they went to SEBI and then and they started drafting the DRHP, then the lawyers discovered that compliance gap, and then they had to go through a so-called exit process mandated by SEBI, and then SEBI will look at every aspect of the process, and that can trip up. It tripped up RBL, and it also became in SI's case also, it was an issue. Of course, all of these are public knowledge. So that was one big compliance gap which was taking place for a long time. Plus, if you have got material compliance requirements, material licensing requirements, basic and fundamental licensing requirements for a business, and those are not in place, the lawyers and bankers are not even going to allow you to file the DRHP. And SEBI will not even allow the process to go forward till those compliances are closed. So that's one issue which is very important. Then the housekeeping, your financial data readiness, your financial statements, then the restatement of financial statements, translating the financial statements into Ind AS, which is an IFRS mirror sort of that. That takes some time, and depending on the size of the business, depending on the number of entities, it could take its own time. If you are planning to do some demerger or acquisition or some corporate restructuring, then of course that is something which sometimes the banker says finish it, sometimes SEBI says finish it and then come to me, and sometimes it allows it to go through. It all depends on the mind and thinking of the person at that point of time. You could have documentation gaps, and you might have some claims you want to make in the document for which you don't have supporting documentation. You may not have supporting documentation to support your shared transactions which have taken place since history. So some fundamental things are that your memorandum history has to be fully complete along with supporting documents. Your entire share capital history has to be complete along with all supporting documents. If you don't have supporting documents, that could trip up your process. So all founders, CFOs, whoever are there on this call, should make sure from the beginning all corporate records are kept in proper shape. These are things which could potentially trip you up. If you've got lenders or you've got certain other parties which have material transactions, approvals from them may be required in terms of document. So those are something should be anticipated in advance and start getting them on like sort of buy-in into your plans. And the most important thing is planning. A lot of companies suddenly decide, okay, let's go for IPO and let's start it. And most of the time it takes a lot of time to get through the process. But if you plan in advance and if you keep all stakeholders involved in the decision making, the finance team, the secretary team, the legal team, operations, and the directors, if all of them are involved in the entire decision making, everyone gets a heads up, everyone starts planning, the process becomes much smoother. And what could trip you up, as I said about the material compliance issues, your corporate restructuring. If you have ongoing material transactions, as I said, then sometimes SEBI will say finish it and come to me. And if there's a compliance issue, sometimes you may even try to file the document with the open compliance issue, saying that I've approached the regulator for closing the issue. Sometimes SEBI may say, no, close it and then come back to me. So it all depends on what the thinking is at that point of time, what's happening at that point of time. If SEBI thinks that there are not enough adequate disclosures in the document about certain items, about your business, about your risks, etc., they might send back the document, do it again and come back. So there's a lot of things which can happen, which can trip you up. But if you plan it well, and if you are aware of these fundamental issues, you're more or less through.
Thank you. I think this was a really useful kind of a laundry list one should be aware of. Laundry list of pitfalls one should avoid.
I have a laundry list. The actual laundry list could run into pages.
Okay. Great. I think quickly it's time for our next poll. I think we are mindful of time as well. Maybe have just 10, 15 minutes more to go. Quickly, Shreya, if you could just put up a poll, please.
Yeah, sure, Naresh. So the second poll is, are all are valid users of IPO proceeds except the options are working capital augmentation, acquisition of unidentified target businesses and firms, debt repayment, and before I read the options, people have started voting. It's buying luxury cars, expensive artworks, and vacation homes for the promoters. So I guess that was pretty obvious. Yeah, so sharing the results.
Very interesting. So 3/4 of the audience has voted for the last option, and nearly 1/5 have voted for the first option. So the jury is out. Devesh, if you could just
Yes.
throw some light on this as well.
Yes.
Essentially, what the question here would be actually, what are the valid uses of the IPO proceeds? And does the law have any say around this, or is it like once you raise the money, you can decide, promoters and founders can decide what to do with it?
It's not really that. So there are some permitted uses. Permitted uses are working capital is allowed, and there's a method of computing the working capital, the money you need for working capital in the future, for growing your working capital. There's a method of computation which the bankers will take you through if you want to do that. You can pay off existing debts, but SEBI does not allow paying off shareholder and promoter debt. So at some point they used to allow it. Now they are no longer allowing it. Yes, you can use it for capital expenditure. Again, it has to be supported by some minimum documentation, which is mentioned in the regulations and which the bankers will advise you. If you have identified an acquisition, you've signed up a term sheet or you've signed up a binding agreement, and yes, you can use it. You can use the money for that. You can use the money to pay off for debt which you have raised for an acquisition also. You can use it for investments in your other businesses, your JVs or subsidiaries. You can use the money for that. And there's something called general corporate purposes, something which you have not identified, but you may require money for unidentified acquisitions which you intend to do. There are limits to that, 25% if it's only for general corporate purposes. General corporate purposes also include the expenses of the issue. That's also part of the reason why you're raising the money. And if you have an unidentified acquisition, then yes, you can go general corporate purposes can go up to 35%. But if you are raising more than 100 crores, the use of the proceeds is subject to reporting and scrutiny by a monitoring agency. Whether you require a monitoring agency or not, whether you're below 100 crores or not, every quarter the use of the proceeds will have to be reported on by the auditor. So it's not like you can do whatever you want. But if you want to change the use of the proceeds from what you state in the prospectus, say 6 months down the line, you want to use the money for something else, then the law says that you have to give an option to the shareholders to sell their shares or exit, and there's a whole regime around that. So if you raise the money for X and you want to use it for Y, then you have to give an option to the shareholders to reassess their options, in one sense.
Great, thanks. So I think just last couple of questions before we just take the audience questions as well. So, Devesh, with your 3.5 decades of rich experience working in various kind of companies, from MNCs to professionally managed companies to maybe promoter-held companies, and also I understand you worked in various roles, finance, IT, and so on and so forth. Just wanted to maybe draw upon this and understand your entire journey and what has been your learnings in supporting companies in their IPO readiness journey. So if you could just maybe throw some light on that, would be helpful.
Yes, I think so. One of the things I mentioned, a key is that there should be involvement of the finance team and the related teams in the entire decision making. So they have a heads up, they start planning, and they start planning for maybe scaling up, start planning to augment the team, start planning the entire preparation for the process. It's important to give them a heads up if you want the process to go smoothly. And you need to prepare certain things, fundamental things you need to be ready with, your financial statements, all your legal and operational compliances, you must be on top of it, all your litigation, and what's the impact of the litigation. And litigation is not only with the company, it's litigation of the promoters also, litigation of the group companies also. Everything has to be disclosed, the impact of everything has to be assessed. If anything is material, it has to be disclosed. If it is not material, you have a kind of box around it. Anything which is criminal proceedings has to be disclosed. Your shareholding and group structure, as I mentioned, the entire history has to be in place with all your supporting corporate documentation. You have to put your governance structure in place as mandated by the LODR. Yes, this is the one aspect of LODR which has to be in place before listing. Your committees, independent directors, and the charter of the committees, everything has to be in place. Your data bank has to be ready. Data bank is not only your financial statements. It's all your operational data, all your non-operational data, financial data. Everything has to be ready, because when the lawyers and the bankers are preparing your document and you are trying to explain your business, you're trying to explain the risks of your business, then they are going to look at various data points. If your data is not in a readiness stage, everyone gets jittery. If you are not able to explain your trends and patterns correctly of your financial statements, the bankers and counsel get jittery. That's the last thing you want to do. That's why you have to be on top of all these things. And the last thing, which is now becoming very cumbersome and which is becoming most time taking now, is promoter and promoter group identification. What is written in the ICDR is not what is actually practiced. The stock exchanges have come up with their own table of promoters and promoter group companies and entities. Bankers will take you through it. And if there's someone going for an IPO, this is one of the first questions you need to ask the banker. Show me this. I want to start doing this right now. That is going to take more time now than financial statements, depending on the web of entities and the structure and the promoter structures you have in place. Now, how do I prepare all these things? Now, financial statements, compliances, etc. How do I prepare? How do I go about preparing it? So, of course, if you know of it in advance, then you need to make sure that your financial statements are Ind AS ready, because all companies going for listing have to be on Ind AS, which is the sort of mirror of IFRS. They also have to be restated for certain items to make them uniformly read. So if there are certain items which relate to different years, if there are certain audit qualifications, if there are certain changes in accounting policies, all have to be sorted out to make it all uniform. Conduct your own in-house diligence if you can, or get someone to do it, so that if there are any compliance gaps, any issues in your processes, internal controls, your litigation, your legal compliances, get it all sorted out, identify it, be on top of it, get it sorted out. Prepare your entire data bank for 3 years. Operational data, non-operational data, patterns, risks, trends, everything. Keep it ready. Start preparing for investor communication. I don't know, a lot of companies have do not prepare an annual report other than the director's report and the financial statements. Start preparing something beyond that, because that is what you will want to use to communicate to investors in future. Get your board and governance in place and start practicing, as Arun said, start practicing the whole routine around information sharing, information giving to the board, getting them involved in the history of the transactions, related party transactions, other things. So start getting used to the process, so that suddenly it's not like a culture shock for you on one day. Oh, now I have to give so many things to the board. Start getting used to it. If you have the time, start getting used to it. And prepare for life after IPO, because after IPO, you are on a quarterly treadmill, you're on a constant treadmill. And if you have been closing your books quarterly or semi-annually or annually, start closing it monthly, so that the end of the quarter is not throwing up surprises for you. So start preparing for it. And it's a myth that IPO preparation starts by appointing my bankers. No, it starts much earlier. If you actually want to go through it successfully and properly, it starts much earlier, 12, 18 months before. Start getting used to it and put all the systems and processes in place. And very importantly, you have to make yourself and your team mentally and physically ready for the process. This is very important. Instead of giving them a culture shock one day, okay, I'm going for IPO, chalo, let's go. If you do all these things, yes, you are ready for the process.
Thank you. And I think this was really, really useful to know. So just the last question from my side. I think actually my question is more a common pain point, which I see for certain investors, who put all their faith in IPOs. So I mentioned that last year, in 2025, two-thirds of the companies or the IPOs delivered positive returns for the investors. So the corollary to that is that one-third of the IPOs fail to do so, right? So just from the point of view of a founder, how does one assuage the concerns of these kind of investors, where they see that the IPO price, upon listing is when they've lost money for the initial set of backers. How should one handle that? Maybe this is the softer aspects.
Yeah. So this is the softer side of an IPO preparation. The softer side is the harder part, and the hard part is what I just told you a couple of minutes back is actually the easier part. Why? Because that hardware is in your control, and you can actually do something about it and get it in shape. This softer side is what I would call the software, and which is harder, because there are various factors around this. There's the market, state of the markets, the timing, the storyboard which you have. But most importantly is what is the credibility you bring to the table. How much do the investors understand and believe in your business model and your business? And whether you are able to credibly explain what you did in the past and what you can do in the future. Now, why are the recent IPOs or whatever, some of them which are listed below the issue price, why did that happen? Of course, in a few cases, it was unrealistic valuations. People recognized that and they started dumping. They invested in the stock expecting a listing day gain, but they did not get it and they started dumping the stock. You take a case like Hyundai, the first quarter after listing, the results were lower than the previous year results. Did the management not know it? Of course, everyone knew it, that this is not going to happen or this is going to be such kind of results. Disappointing results, stock tanks. So, of course, obviously everyone wants to get the optimum valuation in an IPO. But if you want longer term success, if you want to continue raising money to the public markets, if you want the investor base to stay with you, if you want the anchor investors and the long term investors to stay with you, people suggest putting some money on the table. Now, what is putting some money on the table? If your valuation is say 10,000 crores, put it at 9,000, 9,500 crores. Let people make money. Let people see the runway. Let people make money. You're not going to lose much, but you are giving investors an opportunity to make money. Investors who make money in a company will stick with the company and continue investing more money with you when you want. Of course, if you list on a day and on that day Mr. Trump decides to do something, you can't help it. It's not in your control. That's why I said the software side is the harder part and the hardware side is the easier part.
I think well said. The Trump factor is outside everyone's control, be it companies or governments, globally as well. I agree with that. I think that concludes it from our side in terms of the questions. Quickly, we'll just pick up a select questions from the audience. I think we have been quite, enthusiastic
Yes.
over here.
So I'll take one very quick one. So once somebody had asked that, do we get this PPT? So after the webinar, by tomorrow you will have the full recording of the webinar that we share with all the people. Still, if you're looking for specifically the presentation, you may write back to us and we'll send it on an individual basis. Devesh, coming to some of the questions, one question is, what are the pros and cons of a company getting listed as a professionally managed company vis-a-vis a promoter-led company?
Well, the regulations say that you have to define a promoter, and in certain cases where you have got more than 10% or 20% shareholding, or someone has got indirectly 10 or 20% shareholding, indirectly influences the company, indirectly has control over governance of the company, you have to name that company as a promoter, or the entity as a promoter, or the person as a promoter. You cannot escape it. Yes, if you do not have such a situation, then you are allowed to call yourself a professionally managed company without a promoter. So it's not a pro and con kind of thing. It's what the regulation requires and how you define a promoter.
Okay. Next one, for a private limited company to go public, is there a limit of how much minimum should be your holding? And is it not important to have a generation continuity?
So I would suggest for older companies, legacy companies trying to go public, and in order to retain control, and in order to make sure that the legacy continues in one sense. And if you fall within that bracket where you need to offload only 10% initially or less than 25% initially, then yes, you should take that option. Try and maintain the majority. No one stops you from maintaining the majority, 51, 60, 61, 70, whatever is your comfort zone, maintain it. No one stops you from doing it. But ultimately, at some point, you will have to bring non-promoter shareholders as 25% of your capital structure.
Next one, as an expert, what are the KPI you look into the company and its promoters coming for the IPO?
So now for the last couple of years, SEBI has started defining that the KPIs have to be defined by the company. The KPIs which the company uses for its internal management and financial reviews, it is supposed to be disclosed, and you have to continue reporting on those KPIs for 1 year after listing. Now, there are certain KPIs which SEBI thinks is standard, and you can't do away with it. So it's like revenue growth, profit growth. Sometimes it looks for gross margin, EBITDA, etc. But you could have various other things depending on the unique nature of your business. in a retail or the e-commerce kind of business, you might have different ratios like your gross value and your net value and your cost of acquisition and different kinds of things. Yes, you go through all that and you look at the KPIs and disclose those KPIs which you think are meaningful to analyze your business, meaningful for investors to understand your business and analyze your business. But fundamentally, markets value the company based on profit after tax. Ultimately, the valuation is a multiple of your profit after tax, what is called the PE, price earnings ratio. It all boils down to that end of the day. No matter what different metrics you throw up, multiple of revenue or EBITDA or adjusted EBITDA or pro forma EBITDA or different kinds of suffixes and prefixes to it, ultimately PAT is the measure by which markets assess you. And sustainable PAT is even better.
Okay. Next one. Should a company with 100 crores turnover and 20% PBT margin pursue a main board or an SME IPO? What is the rationale?
At 100 crores of revenue and 20 crores of PBT, I would assume that the PAT would be in the nature of in the region of 15 crores or so, I would imagine. I would suggest go for SME, not on the main board.
Okay.
Unless you get 100 times multiple on your PAT, you can go for main board.
Any specific rationale behind it that you would like to share here?
I think the reason is because then you become very small. You don't even get into the micro cap category. And how many people will even look at you over there? And how many people will want to trade your stock and will just be there sitting over there? So as I said, unless you get a huge multiple, you've got like a super business which no one else can do, unique business, tech-based, no one else in the world has it, and you get a super profit out of it, just go for main board, people will lap it up.
Okay. Another continuation to the first question. How will public market investors primarily value a company if there are no comparable public peer set?
That is a bit tricky. You will somehow have to find some comparable company, but if you don't have a comparable company, you have to make sure that you are able to explain the business. The bankers and the analysts of the bankers, etc., will help you explain the business to investors, new investors. It is quite possible that there's similar businesses in other parts of the world, and so the bankers will look for those investors who have invested in those businesses and who have funds and investments in India. So the bankers will take you through it, and if the anchor investors and institutional investors come on board, then retail investors will follow, and over a period of time they will understand your business. But the main thing is that the bankers, and maybe you will also know of investors in similar businesses across the world. Like I'll give you an example of SIS. We are a security and facility management company, and we were the first security company to list in India. So who are the comparables? There were no real comparables in India, and the bankers forcibly made two comparables, like staffing companies, for example. But we also taught the bankers and educated them. These are the investors of security companies across the world. Go and catch them, and then you will understand how to do the valuation and what kind of value a security company brings and puts on the table compared to a staffing company. So the founders will know it, the management will know it, and to some extent it's a to and fro with the bankers. You teach them, they teach you.
Okay. Next one. Do you think there is a minimum revenue EBITDA PAT threshold that a company should have while thinking of an IPO?
So I showed the minimum criteria you need to achieve for main board and SME. As long as you meet that criteria, then yes, you can list. If you don't meet that criteria, then I said you have to put 75% to QIBs. But of course, it all depends on whether the banker also thinks it is feasible. If the banker does not think it is feasible, then you're going to have a problem.
Okay. I think there's one last question I'd like to take. We've already overshot our time. So when does a company go private from being public and why?
So if you think, now of course in public markets, a lot of times you tend to take a quarterly view of life because that's what the markets are doing. Your investors and analysts are taking a quarterly view. Though you would like to take a long-term view, everyone wants you to take a long-term view, but they look at you quarterly. So that's the contradiction and the paradox which you face every day. But if you actually think you want to restructure the business and you want to rejig the entire business and pivot it and do something else, for example, Dell. Dell took the company back private from public because there was too much scrutiny and they were not able to achieve or implement the long-term plans. If you are in such a situation or you think the stock is not getting valued properly and you think there's much more value to the stock than what is actually being given by the investors or the market, and you think it's not worth it, then yes, delist and get back to private, implement your plans, and when you think it's in a different kind of a shape, or if you think your business is in a different kind of a shape now, and now the market will value me better, you can get back. ISEC got delisted recently. Of course, there was controversy around it, on the way they got it delisted, but they ultimately got it delisted.
Great. So I think we had a very engaging session. I think it's amongst the very few where we have overshot time there, and it's been great. Uh, yeah, I think I'll have Arun maybe close it with final marks, and then we wish everybody a very happy evening. Arun.
Thanks, Richard. Mr. Desai, I must thank you for a very, very engaging session. Very,
Thank
very
you.
insightful as well. And I think your experience in terms of leading companies to successful IPOs and having seen the pre-IPO stage, the IPO stage, and the post-IPO stage, managing each life stage, as you said, definitely came across. And I think most our audience, would have found it very, very, insightful as well. And a big thanks to our audience. I think very engaging, the fact that we've overshot our time, a lot of questions, a lot of very specific questions. Thank you all. Thanks for joining in. At Merisis Wealth, it has been our continuous endeavor to have these kind of webinars to provide and to value add, to certain very specific topic. Today's was one such case. Please feel free to reach out to us in case you want to connect to Mr. Desai. And I must also add that we do provide treasury solution, customized solutions for corporates and also investment solutions for individuals. Please do reach out. Like Richard said, we will be sending out the recording of this session to all of you individually. Thank you all. Thanks again. All the best. Have a great day. Thank you.
Thank you.
Thank you, everyone. Thank you for hosting me. Thanks.
Thanks.
Thank you, everyone.